Good morning and welcome to the Saxo Bank Morning Call. It is Tuesday, March 26, 2019, and I want to start off the program today. Very brief plug for our webinars this week. All three of us, the three musketeers here on the SaxoStrats team with webinars. Starting today, you have Ole up today with commodities at 13:30 Central European time. Peter on equities tomorrow, and myself on FX on Thursday. So tune in for some sort of a bit more broad-based and deeper thoughts on what's going on, what's moving the markets, and our look at our various asset class specialties. Back to the markets, I think I wanted to also just take on a more broad-based view on where are we in markets right now. We talked yesterday about the post-FOMC reaction. First, we had a brief celebration, and then we saw an ugly sell-off on Friday, maybe some quad witching involved in both the Thursday and Friday market action. I think we're at an interesting pivot point here in the coming, right now, and in the coming couple weeks. Whether we're going to go to new all-time highs, for example, in the U.S. equity market, or whether this is already, we sort of over-celebrated what the Fed has brought to the easing table. And there's a great post by the macro tourist. Yeah, you can see the link here on the slide. Actually, you can't because for some reason the link got whited out. But go to themacrotourist.com, and it is his latest post. A brief one, and he says some of the points that I've made before. Let's, basically one of them being, look, we have the yield curve inverting. There's so much attention on that. It is very important and profound signal, but it's one that offers very little intelligence in terms of timing. Also, we need to recognize that we've seen one of the most dramatic and supportive pivots to the dovish side from the Fed in its history. And the Fed caving is one of the reasons, obviously, why we've seen such a response in risk appetite. And he believes, and I would argue history has shown, that the Fed isn't able to see something that the market doesn't yet see. In other words, that the Fed isn't panicking because of some deeper thing going on here that the market is not privy to. Let's just go back to Bernanke around the housing crisis and his inability to see the import of subprime and what that could do to banks when that rolled over. And basically, his scenarios look at 1998. Remember the setup there. We had a very ugly financial crisis low, Peter. I'm sure you recall that big sell-off. And then we saw Greenspan responding with rate cuts and that crazy run into the early 2000 environment. So an interesting setup, worth considering. Let's keep our minds open as we see which way the markets pivot here. I could argue we could get something in between this where we see maybe not a year-and-a-half rally like we saw back in 1998, but we could see a few months of upside in such a scenario. What do you think of this logic that the macro tourist, or Kevin Mears, his name is, outlines?
I think he points to some very valid arguments about where the market is going, and I'm actually going to touch on some of the key points here in my equity update today, which will be out on home.saxo. But especially in 1998, we've talked about it before, John. I think it's probably the most key comparison right now in the market. I can see both scenarios. I can see a scenario where we actually trend lower in equities. It all depends, in my opinion, about China and specifically the U.S. and Chinese relationship. But I can also see it go, straight up and build up. We have a lot of technology IPOs coming. Technology earnings are still growing fast, and if interest rates maybe even cut now, it looks like from the Fed fund futures, the market is actually pricing in a 25 basis point cut within this year. If that happens,
I would say even in this scenario, it wouldn't necessarily take a cut. As long as the economic numbers don't start to head south, as the market seems to be fearing, even just maintaining a flat rate is going to be enough, I would argue, to support that.
Exactly, and I think there is one joker that people don't really talk that much about, and that is that keep in mind that the deficit is expanding rapidly in the U.S. That's a massive fiscal impulse which is coming into the U.S. economy. I think that it is so big that it actually offsets any small changes in the monetary policy at this point in time on this part of the economic cycle.
It's an interesting, we're not going to promote this view, but it's an interesting point of view to consider, and we'll let the markets speak their own truth. I'd have a couple of points at the bottom of the slide here. What would a market look like besides obviously an equity rally if this is the scenario? Well, I would expect the yield curve to steepen again a bit, actually, because you would have to believe that longer dated treasuries would come under pressure in such a scenario, even if the short end of the curve remains relatively flat. The yen, I would argue, would be the weakest currency in the FX space, and risk currencies could perform well, especially anything linked to commodities or the idea that that economic demand around the world is going to stay reasonably stable. And then I would argue, and we saw this experience back in 1999, a much more volatile bull market, and that would be very interesting and much more dynamic back and forth, even if the direction isn't necessarily lower, which is usually what you associate with such markets.
Exactly.
So, just one more slide just to show you, just to recap what happened to the yield curve back in 1998. you see that flattening. It actually managed to invert slightly mid-1998. I think maybe some of that spike there you see in late 1998 could be linked to something with the benchmark. And then we saw, of course, the crazy markets of 1999 bull market, and then the big, profound inversion didn't happen until 2000, setting up, obviously, the big tech crash and a small recession we had back in 2001 before Greenspan started chopping rates like there was no tomorrow. And on the S&P, just a small chart here just to remind us where we are. I would argue we're getting an indication already very quickly of whether this is a scenario if we just simply go to these new local highs. Sort of rejecting this sort of post-FOMC price action would be a strong signal, I think, and then we're only a couple, 2-3% from the highs for the cycle back in late 2018. Yeah. One counter narrative or one counter indicator, Peter, you've provided here, the small caps are not super happy, and I noticed the transports as well. We're not looking particularly good right here.
Exactly, as you can see here, we have you didn't even get a double top formation in the small cap, the Russell 2000 here. We didn't even get to the highs from February here in March. So and the session on Friday was very ugly for small cap, and I think the price behavior here indicates to me that I would not be surprised to see CTAs or trend following funds beginning to sell pretty heavily the US small caps. And I think small caps is probably more, could potentially be a more clear signal of what's going on in the US equity market than the S&P 500, which is dominated by the big US technology companies. And Apple, which we'll be talking about in a few minutes, has really been accelerating to the upside on very strong sentiment.
Well, let's, again, with the counter narrative to that, the positive being, remember the huge divergence back in 1999, 2000. Again, it was tech stocks back then, where all the market was piling into the big market cap tech stocks that ran the one way, whereas the rest of the market was relatively flat to actually down. So interesting parallels, maybe all the way around. Chinese equities overnight, however, not a bull party there.
Not very inspiring. There's a divergence. We saw a 2.5% jump in Japanese equities, whereas mainland Chinese equities were down almost 1.5%. I've just drawn the red line here. I personally think where levels and the technicals, I think, is very dynamic. I don't know whether this is really the red line in the sand, but at least that's where I put it right now. I think for now we're just in a range trading environment here with China. I think they're taking a pause. I think the news flow has dried up a little bit. On yesterday, we had the biggest outflow from foreign investors through the Stock Connect on mainland shares. I think that sort of is pretty key information to think a little bit about here.
Maybe some concerns, at least just to speculate, maybe some concerns that this U.S.-China trade deal might just disappoint, might be a weak deal or whatever.
Obviously, but also I think that it's interesting to keep in mind that if I just looked at the financials, the big Chinese banking stocks are actually quite weak, like technically compared to the rest of the market. So I don't think it's a one-way street here in China. I think there is some internal divergence in the mainland equity market. So let's see where Chinese equities go. But if we go below the red line, I think we could have a different narrative on China again.
Okay. Jumping around a bit, but we do have this Apple story out. It's a rather big, bold move direction-wise from Apple. They're obviously switching over their focus to where they think they have growth on the services side, because the handset hardware side is maybe drying up in terms of growth potential.
The hardware sales, as you said, slowing down. There's no growth. They know they need to, change the mix of revenue into services, software, entertainment. And if you look at the slide here, I just brought up some of the key points from the presentation yesterday. So they're doing something called an Apple credit card together with Goldman Sachs and MasterCard. And I've highlighted in red from their own press release, I think, which is pretty key. Apple is playing this privacy game against Google, against Facebook, where they're saying we will never share or sell data to third parties for marketing or advertising. I think this is going to be key, that they're choosing a path that it doesn't involve advertising or selling data. So I think Apple is setting themselves up a pretty interesting thing here. And they do news, not that interesting. I think Apple Arcade is a similar move to what Google just did. It seems like everyone wants to have a bite of that e-gaming trend, and then they... Is
this a look over your shoulder at what other people are gaming, or is it actually participating in the gaming?
I think this is a platform. I don't think it's only a facilitation of gaming. And then they're doing they're upgrading their Apple TV, and they do something called Apple TV Plus, where you actually get access to original content. So they're now moving into the space where Netflix is, HBO, Amazon, and Disney is also rolling out their new live streaming service. I think it's going to be an extremely crowded space. So what's Netflix, their reaction to it's the news that Apple is moving into this space. So
yeah, I need to be a content creator. I think seems to be there's some customers for good content.
Exactly.
So, all right, and on the stock chart itself, we have we suffered a pretty crushing sell-off there in late 2018, and we've only taken back about half of that, or not even quite.
Yeah, the sharp decline was the news that sales is just plunging in China. It's a Chinese story, the sell-off, and now we've come back half the way. I just wanted to give you the perspective. Apple is still a very high quality stock. I still think that they have room for more growth if they can transition away from being very dependent on hardware towards services and software sales, etc. So, but in the short term, it's probably a little bit overboard here. But I think the news yesterday is very encouraging for long-term investors.
It'll be interesting to see how that shakes out. For the beta on where do you, in the currency market, where do we trade risk on, risk off? Is this going to be a 1998 to into 1999 rerun, or the other way around? I would argue dollar yen is one of the highest beta, or at least yen pair is one of the highest beta currency pairs, or the yen is the highest beta currency to the situation, especially in the long end of the U.S. Treasury market. Got a chart here. We had the sell-off. It looks pretty bearish as long as we stay below 111. So I would argue as long as we're below 111, the bears have the upper hand here. But if equities are crawling back higher and treasuries come under pressure, then I think that could be at risk of falling again. So an interesting one to watch there. Note as well that 110 level, psychologically important. That's the lower horizontal line, and then the Ichimoku cloud level around the same level as well. And a final note before we get to the calendar, there's a story that's just, I think we need to all have in the back of our minds, something that's rather concerning. I would argue we have Venezuela and Russian boots on the ground, military boots on the ground in Venezuela. I find this very unsettling, right in the U.S.'s backyard. This could lead to something rather dramatic, certainly in the ruble, but geopolitically, just have your feelers out there for what is going to happen next. I have a chart of the ruble, dollar ruble here. Surprised, actually shocked that we're trading where we are. I think speaks to a pretty strong risk bid on EM, and especially the ruble with the positive yields and the flows we've seen into Russia to snap up government bonds. But be wary there, especially if you have any Russia or ruble exposure that could potentially go just about anywhere. Now, onto our calendar. I want to note a couple things. I've not talked about Brexit today. It's a very fluid situation. Do follow what's going on. The Parliament has totally seized the initiative from Prime Minister May. They're looking for a new way forward on Brexit. They're going to be indicative votes in coming days on what to do next. But I also want to highlight the U.S. 2-year auction. Today we have a 5-year auction tomorrow and a 7-year auction on Thursday. I think those 5 and 7s may be a bit more interesting because we're further out the curve. If we're seeing less robust demand, it could be nudging us towards that idea of a yield curve steepener. If we see very profound demand, I would take it as a risk-off signal. So I think these are key. The very large auctions, we're talking about over $100 billion. I think it's $130 billion in these 2 to 7-year treasuries being auctioned this week from the Treasury. So keep those auctions on your radar. As well, housing starts, building permits, a few other bits, and I just want to mention New Zealand RBNZ as Kiwi versus the dollar trading at key resistance around 69 plus. If they don't send a dovish signal and we have reasonably positive risk sentiment, we could see the Kiwi popping even higher than it has been in this range of late. That'll do it for us today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.